Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is March 26, 2016 edition of Market Outlook. Markets shrugged off the news of the terrorist attacks this week and set up some interesting patterns. Let's get into it right away. First of all, the chart on the S&P is most indicative. Look what's setting up here. First of all, you have traded for at least a week and a half well above the 200-day moving average, which is this in green. Interestingly enough, the test on the Friday morning after the terrorist attack and the digestion of that news basically opened up right on the 200-day moving average. It took the rest of Friday to close on the highs. But a couple of things have occurred here. First, we closed under the 10-day moving average, which is a first since the low was put in all the way back in February. So that is an interesting first. In addition, we have a 1, 2, 3-point trend line that was broken on Thursday. So that is interesting to note. So we're sort of wedged between two levels of deterioration and this support. Now, the most critical level on price action to watch is this swing point right here. And that comes in right around 201. Reason being is you have a spike low, another spike low, the spike high before the market actually closed above the 200-day moving average. So critical level, 201 is the level to watch. If that gets broken, that will confirm the downside on multiple fronts. So break of the moving average, the 10-day, a break of the 200, and on top of that, a break of a critical swing support level, which is that 201 level. So that is critical to watch. On the other hand, if we can close above the 10-day moving average, which comes in at 203.50 or so, that would really resume the upside action as well. So we definitely want to watch that. All right, let's take a look at a couple of other market internals. One chart I like to watch is the market breadth chart, which looks at the number of stocks above the 10, 50, and 200-day moving average. The cyan line is a good short-term indicator. And again, when you get to the 375 level and the 125 level, that approaches both overbought on the 350 or 375 level to the 125, which starts to get to be a bit oversold. And then, of course, the extreme levels are at much higher points as well. So we have been sitting at a pretty overbought level and dropped down sharply over the last couple days. So that level of deterioration is interesting to note. Another point here is I drew some different trend lines on this S&P daily chart. This has been here for several weeks to a couple of months in terms of the lows since the mid part or the latter part of last year and the channel it trades in. So interestingly enough, this channel, which had been put in, basically we dropped the line here against critical closing prices, basically the body of the candles, the highs and lows. And as you can see, this trend line here is a critical swing point as well. So we got and touched right above that 205 level and have sold off. If we can power through the upper end of this channel, that would probably portend a good 2-3% more rally back up to about 211 in the S&P. On the other hand, we've now been contained by this this channel that's defined by this lower line here and the upper line. Tests down to the mid 190 level would be in line, especially if the market continues to roll over. And again, break that critical point of 201. 201 Any close under there would put this market under pressure. Let's take a look at the Market Gauge website and some of the market internals on Little Big View. Okay. Well, first of all, you can see we've, in the last couple of days, we've picked up some distribution days. It still hasn't really generated a sell signal per se. It's pretty balanced between accumulation and distribution, although now on the S&P and the NASDAQ favoring a bit more distribution. So this is a definite deterioration in the overall volume pattern as well. And again, just to review, you can go to marketgauge.com, go under resources, and you can see Little Big View, and that's where we are. Right? So now let's take a look at the sector scenario. We like to take a look at the sectors, see which ones are leading. That's a generally interesting indication. How many are up or down, and whether we're above the 200-day moving average. So as we've closed above the 200-day moving average, we certainly have lots of sectors that have positive performance over the last 6 months. So you can see down here, right, we're above the 200. We have more sectors above the above their 6-month rate of change. They're positive, and the overall condition of the sectors is looking definitely okay, as long as we stay above that 200-day moving average, right? And again, if it takes out that 201 level, that will violate it and put this more into a neutral level. Now, what is interesting is that utilities still are leading as the key sector. So even while you have consumer staples and technology coming up close behind, technology is a good sign as things move more into speculative type of investments. But really, consumer staples and utilities, which are the top two sectors now, are really conservative bets and a flight to safety and yield. So very, very mixed here in terms of what the overall sector rotation is telling you. I would say it's more still in the camp of nervousness and a bit of bearishness, although a significant improvement over the last 45 days, where technology and semiconductors are picking up in ranking here and positive. So you can see a positive change occurring, but overall still some and still quite a bit of pessimism in the markets. Okay, let's go to some market internals. Let's take a look at the New York Stock Exchange advanced decline. One thing you can see, as we've made new successive highs, look what's happened here. This is the up-down ratio, the 5-day, definitely deteriorating and actually crossing the midpoint. So this particular indicator definitely deteriorating and on a sell signal. The advanced decline, the 10-day advanced decline, falling as well. Not quite as poorly as the up-down volume, which is clearly weaker as it's moved beyond the 50% or the flat level here. So again, deterioration on the market internals. Interesting, looking out over about 3 weeks to a month, which is the McClellan oscillator, which looks at the 39-day period of advances versus declines. That has really deteriorated and is now sitting at the 0 level, and that is not a good sign, right? If we continue to drop down through here, clearly you're going to have all three of these market internal indicators, advanced decline, up-down volume, deteriorating from the succession of new highs that it made, and obviously on the recent highs, failing and turning down. That is clearly negative. So market internals, definitely deteriorating. Volume, definitely deteriorating here. This is the composite, the NASDAQ, and again, NASDAQ never really approached the same positive readings, getting over the 200-day moving average, which is that black line, and definitely quite a bit weaker. And in fact, you can see as the market's been making new highs, market internals across the board hit overbought levels and have not been able to gain any strength whatsoever. So definitely market internals under pressure here. If we start dropping a bit more, it'll really confirm that we're headed more to a situation where we're going to look for potential more significant sell-off, and let's see where that takes these indicators, and maybe it'll set up for a re-entry price here on the long side at much lower levels. Let's take a look at new highs, new lows. You can see the S&P was doing great. We were really quite satisfied with this move up, and obviously continually making more new highs than new lows. This ratio is extremely positive. But notice what's happening here. Starting to roll over at what we would consider a very overbought area. So we're going to watch this very closely. And again, a little bit more deterioration would generate a potential sell signal. Not quite there, but we are starting to roll over. So it could be that the momentum of this rally losing steam, right? The up-down volume, the advanced declines, all starting to deteriorate as we seem to be running out of steam right here. Let's go to the next chart. Well, again, we were talking quite a bit about NASDAQ over the last couple of weeks and how that has certainly lagged the S&P. We are above what we would call the midpoint here of the ratio, so it definitely was improving. And actually, on this basis, NASDAQ is looking a bit firm right around this key level, which is the midpoint of a new highs versus new lows. So I would say we really do have to watch this NASDAQ, because this could give us a good lead. If we start moving back up here, and again, you can come back and check these tables every day. If the market new highs versus new lows on NASDAQ start improving, that could give you a clue as to maybe the S&P will be turning around as well. So we want to watch this this midpoint level right here and see what NASDAQ, the QQQs portend, but overall looking a little bit more positive on this new high, new low ratio. This is sentiment. Now we're looking at volatility, and you can see volatility hovering, touchdown to the bottom of the band, and stabilizing. So actually, what we'd like to see is the market move back up above the 1867 level in the VIX. Right now, we're trading quite a bit down at the 1415 level. But if we can get back above that longer-term moving average, I'll feel that the sentiment is now confirming the overall a potential sell-off in the S&P. But right now, pessimism is not really pervasive. And of course, the one of my favorite sentiment indicators is looking at 1 month volatility versus 3 month. You can see we got running pretty rich. Again, you want to see the market action confirmed. So here you've got certainly some overbought readings. Market is starting to turn over. Sentiment running pretty frothy. But again, price action needs to confirm what these indicators are doing. And again, 201 level is that critical level. All right, so one last thing I'd like to go to is taking a look at the gold chart. And this is a new indicator that we're working with. I'm going to give you an advanced read. One of the things is that we're looking at momentum relative to a moving average. In this particular case, you can see gold hit the top of the Bollinger Band, and yet this blue line here is momentum, and that moving average of momentum, and this red line is the actual price relative to the moving average. And as you can see, the momentum is starting to roll over. So what we like to see is the Bollinger Band get touched on the upper end and a non-confirm on momentum. And that's exactly what occurred here in gold. So you can see gold really losing steam as it's making new highs, right? You can see we hit new high, hit the top of the Bollinger Band, making a new high, and yet momentum was rolling over, and the red line is the actual movement against the moving average, and this is a moving average of the moving average. This is sort of a rate of change, and that has failed as well. So that was, for those who are actively trading, this is a really interesting setup. We're going to talk more about this new level of price analysis and add it to our mix, so stay tuned for that. But meanwhile, interesting, gold definitely running out of steam and actually now crossing beneath its key moving average. This black line here is a key moving average. It's 20-day moving average and is just falling apart here. So momentum definitely as played out in gold, peaked, and you got an early warning using this methodology. Let's stay tuned. Overall, it looks like on a 200-day basis, looking at a little bit longer, gold is still holding up okay. Let's take a look at that for a moment, and we'll end this session. Where is that chart? Okay, so on the 200-day, this is a similar chart, but using a 200-day analysis. And you can see we definitely have lost momentum, but really, overall, right, when we did make a new high, this did make a new high. So on a longer-term basis, if you're a longer-term trader looking for the sell-off to finish here, we can take a look at that 20-day and look for the inverse of what we just looked at for a confirmation on a renewed buy. At the moment, though, gold definitely under pressure. However, on a longer-term basis, looking back at a 200-day scenario, gold still is in a positive scenario and is in the strongest, one of the strongest places it's been over the last several years, right? You're looking back now to 2013 on a momentum basis, and you can see we're just really moving back down to what was the highs going back several years. So overall, gold still in play, and let's see where this sell-off finishes. Okay, hope this helps. Bye for now. See you next week.